Back in 2015, Bitcoin was trading for just over $200, a price that made most people shrug it off. But a simple $100 investment then would now be worth nearly $50,000. The numbers sound unreal, but the full story is more about patience, volatility, and perspective than pure luck. Bitcoin's starting point, 2015. In August 2015, Bitcoin was trading at around $230. At that rate, $100 would have bought you approximately 0.43 BTC. That same year showed just how unstable the asset already was, with lows of $165 and highs just under $463. Even before mainstream adoption, Bitcoin was swinging wildly. By the end of 2015, Bitcoin was starting to gain attention, but most people dismissed it as a niche project for tech fans. Few believed it could rival traditional investments, let alone grow into something valued in the hundreds of billions of dollars. Yet that $100 stake quietly sat there, waiting to ride the next wave. Breaking milestones. Over the next couple of years, Bitcoin started making headlines. By early 2017, it broke the $1,000 mark for the first time, a milestone that made investors sit up and take notice. Later that same year, Bitcoin rocketed to more than $19,000 by December. Suddenly, this strange digital currency was front-page news. That rally was unlike anything the financial world had seen in decades. People rushed to open accounts on crypto exchanges. Some saw friends and co-workers turning small bets into big paydays. But just as quickly as it surged, Bitcoin fell sharply in 2018. Prices dropped by more than 80% from the highs, leaving many investors devastated. If you had put in $100 back in 2015 and held through the storm, you would still have had far more than your original stake. But for newcomers who bought at the top, the crash served as a brutal lesson in volatility. The pandemic years and the rise to $60,000. Bitcoin's next major rally came in 2020 and 2021. The world was grappling with the COVID-19 pandemic, and traditional markets were in chaos. Governments pumped money into economies, and investors searched for alternatives. Bitcoin became a popular hedge, described by some as digital gold. By late 2020, Bitcoin crossed $20,000 again. Then in 2021, it surged past $60,000. Institutional investors began entering the space. Big-name companies announced Bitcoin purchases, and crypto exchanges gained millions of new users. The price action was breathtaking, but once again, it was followed by steep corrections. For long-term holders from 2015, however, the growth was undeniable. That original 0.43 BTC was now worth tens of thousands of dollars, even after price pullbacks. The key wasn't perfect timing, it was simply staying invested, breaking the $100,000 barrier. By 2024, Bitcoin reached a new record high, surpassing $100,000 for the first time. This rally was fueled by increasing institutional adoption, growing mainstream acceptance, and its hard-coded limited supply. Hedge funds and financial institutions treated it seriously, not as a passing trend. In mid-2025, Bitcoin hit an all-time high of around $122,000. As of August 2025, it trades near $115,000. That means the $100 you invested in 2015, worth 0.43 BTC, would now be valued close to $50,000. It's a return that outpaces gold, stocks, or almost any other investment class in that time frame. But it came at a steep emotional price, years of doubt, collapses, and hype cycles that tested the nerves of every investor. The pizza story. No conversation about Bitcoin's history is complete without the pizza story. In 2010, Laszlo Hanyecz, a Florida programmer, made the first real-world Bitcoin transaction. He paid 10,000 Bitcoin for 2 pizzas. At the time, the coins were worth about $40. Fast forward to August 2025, and with Bitcoin trading above $124,000 at its peak, those same coins would be worth more than $1.24 billion. That single meal has become a symbol of Bitcoin's rise and of how hard it was to predict its future value in those early days. The emotional roller coaster, FOMO and HODL. Part of what makes Bitcoin unique isn't just the price action, it's the psychology behind it. 2 terms sum it up: FOMO and HODL. FOMO, or fear of missing out, drives people to buy when prices are skyrocketing. In 2017, 2021, and 2024, countless investors piled in at the top, afraid of being left behind. Then, when the inevitable crash came, many panicked and sold at a loss. HODL, short for "hold on for dear life," emerged as a mantra for Bitcoin believers. It encouraged people to keep their coins through the turbulence, no matter how bad the charts looked. And history has shown that the hodlers came out ahead, turning small stakes into huge fortunes by simply resisting the urge to sell. Psychological studies confirm that emotions like overconfidence, panic, and social pressure drive many crypto decisions. But investors who tuned out the noise often reaped the biggest rewards. Myths versus reality. For years, Bitcoin was surrounded by myths. One myth claimed it was only for criminals. While some illicit use existed early on, the majority of Bitcoin transactions today are legitimate, from cross-border payments to portfolio diversification. Another myth suggested Bitcoin was just a bubble destined to burst. Yet 16 years after its launch, it remains the most dominant cryptocurrency. Another misconception is that Bitcoin is anonymous. In fact, it's pseudonymous. Every transaction is recorded on the blockchain, visible to anyone. That transparency has made it traceable in ways that surprise many newcomers. Skeptics also said Bitcoin had no real value. But like gold or fiat money, its value comes from trust, scarcity, and utility. Bitcoin's supply is capped at 21 million coins, and its usefulness in transferring funds across the globe gives it staying power. Bitcoin versus gold versus stocks. To put Bitcoin's growth into perspective, compare it with traditional assets. Over the past decade, Bitcoin delivered roughly 45,000% in returns. Gold gained around 200%. The S&P 500 returned between 200% and 300%, depending on the time frame. Gold is often called a safe haven, valued for stability during uncertain times. Stocks deliver steady long-term growth, compounding over decades. Bitcoin outperformed both by a massive margin, but with unprecedented volatility. The lesson is balance. Gold provides safety, stocks provide reliability, and Bitcoin offers explosive upside. A diversified portfolio blending all three helps balance opportunity with security. Risks of investing in Bitcoin. Despite the dazzling numbers, Bitcoin remains speculative. Its price is not tied to earnings, dividends, or tangible assets. It rises and falls based on investor demand. Regulation is another risk. Governments around the world are still shaping crypto policy. Changes in tax rules, trading restrictions, or outright bans could swing prices. Cybersecurity is a concern as well. Exchanges have been hacked, and investors have lost fortunes through stolen private keys or scams. While security has improved, risks remain. Financial advisors generally agree, never invest more in Bitcoin than you're prepared to lose. For many, that means allocating only a small percentage of their portfolio. Bitcoin ETFs, an accessible option. For investors cautious about buying and holding Bitcoin directly, exchange-traded funds offer a simpler path. Bitcoin ETFs let you gain exposure without managing private keys or crypto wallets. They trade like regular stocks, making them easier to buy and sell. But ETFs don't eliminate the volatility. If Bitcoin drops, so does the ETF. What they do provide is accessibility, especially for those who prefer traditional financial platforms. Lessons from a decade of growth. The biggest takeaway from Bitcoin's journey is that time mattered more than timing. Investors who held on, despite multiple crashes, came out ahead. Volatility wasn't a sign of failure, it was the cost of entry for massive growth. Market timing often led to mistakes. People bought high during rallies and sold low during crashes. Buy and hold proved to be a far better strategy, rewarding those who stayed patient. Knowledge and preparation mattered too. Understanding the risks, setting realistic expectations, and resisting emotional decisions all contributed to long-term success. Bottom line, so where does that leave us today? If you had invested $100 in Bitcoin in 2015, you'd now be sitting on nearly $50,000. If it were $1,000, the value would be close to $500,000. Go back further, and the numbers climb into the billions. But those gains weren't guaranteed. They came with years of stomach-churning volatility, endless debates, and moments when selling would have seemed like the safe choice. Bitcoin's story isn't just about price, it's about resilience, patience, and mindset. Looking forward, no one can say for sure where Bitcoin will go next. What we do know is that it has already rewritten the history of investing. And whether you view it as a digital revolution or a speculative gamble, the lesson remains clear. Time, not timing, makes all the difference. So, would you have survived the roller coaster ride from $230,000 to $122,000? And more importantly, what would you do if the next opportunity came along? Let us know your thoughts in the comments.